Thanks for tuning in. I'm David Salem, Managing Director of Capital Allocation here at Hedgeye, and the happy host of a new webcast series that we are launching here and now entitled CIO Corner. As suggested, I hope by its name, the new series is going to try to help serious investors elevate their game in two distinct but kind of related ways. One, by obviously highlighting specific investment opportunities and perils, something we do routinely as part of the capital allocation service. And then secondly, by sharing best practices for both, asset selection and portfolio construction. And in an effort in this very first episode to kind of prove the point, or at least to attempt to prove the point just made, we're going to dedicate this first episode of CIO Corner to a conversation with an investment pro who specializes in assets that many of you watching this video do not own and may never buy or sell, namely digital assets. So why then would those of you who don't invest in those assets and perhaps never will spend the next roughly 58 minutes hearing from a specialist in that form of investing? So I put that question to you and to myself, and I'll answer it by saying, trust me. Given my guest's very distinctive and verifiably successful approach to both asset selection and portfolio construction, I think if you're a serious investor, and our premise is that all of you watching this video are, that you'll be glad that you've devoted the next 57 minutes now to hearing from my guest, Hal Press. I am delighted, Hal, to welcome you as our guest on this first episode. And by prior arrangement, I'll ask you to take, 2 or 3, 4 minutes up front to just sketch your path from your college days at Duke through your first job in finance, through the successive positions that you had right up to the founding of the fund that you're now running, North Rock Digital.
Thank you. Thank you for the introduction, David, and thank you for having me on the show. Like you mentioned, I grew up in New York and did my undergrad at Duke. I studied engineering and math, and then went to work at Morgan Stanley out of school. I did 5 years at Morgan Stanley. The first 3 were in equity derivatives, and that was really where I learned the bulk of my financial and really sort of portfolio management skills. I traded equity options in the tech sector for 3 years. And then I went into the year in equity research, also at Morgan Stanley, and then a year in private equity on the buy side of Morgan Stanley, before eventually going and doing 1 year at Maverick Capital, doing long-short equity tech investing as an analyst in San Francisco. And it was there that I sort of really discovered crypto. And that was in 2021 during that bull run in crypto. And I'm quite an obsessive personality, and crypto's something that you can go pretty deep in if you'd like. And so I dove pretty deep down the rabbit hole and really came to 2 fundamental conclusions that led me to end up starting my own fund. One is that I do believe that the blockchain as a technology innovation is a real thing. And you and I can debate the value of the tokens, and I think that's a much more interesting debate. But I think that there is a real technology innovation in blockchain, and it does require a token to some degree. And I think what that really ensures is that the space has longevity. I mean, the path is very uncertain, but I don't think it's going away anytime soon. And I think, as someone that's potentially going to go work in the space, that gives you a certain assurance that you're going to have somewhere to work. But then the second factor that I think is honestly kind of more relevant to myself and what we ended up doing with the fund is just that I think that crypto is by far really the least efficient liquid market that exists in the world today. And, as an active manager, that's a very attractive trait and characteristic of a space where your job is really to take advantage of those inefficiencies and try to outperform some index.
Excellent. So by prior arrangement, we've got a number of topics you've just flagged that we're going to double click on as the next 55 minutes unfold. But what I want to do right now, Hal, and I gave you advance notice I wanted to do it, take again 3 or 5 minutes, give us an overview. I know there are limits as to what you can do because of marketing and legal constraints, but just a broad overview of what I would call the selection universe that you're reviewing as manager of North Rock Digital, the risk parameters or guardrails and the associated return objectives that govern the whole investment program, other parameters I asked you to talk about up front here, what you deem to be the optimal period for assessing the fund's evolving performance, and we'll take it from there.
Yeah, sure. And just to finish up on the last point is just that I ended up founding North Rock in 21, and we've just been running it up until now. And then to move on to this question, I think the sort of the universe of assets that we look at is broadly all sort of liquid tokens. So I'd define that as probably the top 500 largest by market cap liquid tokens. Obviously, Bitcoin and ETH are the two largest, but there's a whole other host of tokens beneath that. And that's kind of the primary universe that we operate in. And then also we do trade some crypto equities. So whether that be like any of the grayscale trusts, GBTC or ETH, and then some of the minor stocks like Marathon or MicroStrategy as a Bitcoin holding company, Coinbase, etc. So I think the general broad universe that we look at is the digital assets themselves, and then some equities that are involved in the space. In terms of sort of the guardrails that we run the fund by, we actually don't really, we have a pretty broad-based mandate to kind of do as we see fit to just make as much money as possible. That's really the objective. We don't actually use an index. It's just absolute returns that we target. However, we have quite a few self-enforced sort of guide rails that we use. I mean, we typically won't take the net outside of short 100 to long 100. We won't run with leverage in either direction on a net basis. And then the gross, we typically keep the gross relatively low, but I don't think we have ever or probably would ever exceed 200% gross. So that's kind of like the net and gross guardrails. And then within individual positions, we do often take concentrated positions. So I wouldn't say that there's a sort of a limit there, but certainly on the short side, we're quite cognizant of not oversizing things because of just the asymmetry of shorting. So typically, it's very unlikely that we'd have sort of structural short positions in greater than 5% of the fund, I'd say. But on the long side, we could be a little bit larger. And that's the kind of the broad-based guardrails that we run by. And then in terms of hold period, we typically, I mean, we operate on different time frames depending on what we're doing. But I'd say like the standard sort of thesis-driven hold period is roughly 6 months.
Excellent. So a little bit of my own backstory with you, just by way of full disclosure in it, because it's a good segue to the next question that I want to pose to you about your sort of thesis-driven approach to investing. You and I met not long after you launched North Rock. Full disclosure, my family has a little bit of money with you, and then the little foundation my brother and I set up years ago has some money in North Rock too. So that's by way of disclosure. But one of the things that really intrigued me when we first got to know each other, and I dug into your own work as part of my own due diligence, was just how thorough you were in both researching and then writing about and speaking about the theses that were animating the construction of the portfolio. Obviously, Ethereum and the merge was one big deal for you. Just if you can go back to the founding of North Rock, and maybe even Hal, even before the founding of North Rock, what have been the principal theses that have come to mind that you've tried to exploit in the portfolio, and how have they worked out in candor?
Yeah, we typically run a very thesis-driven approach. We try to identify catalysts and fundamentals that are going to happen sort of in some knowable fashion in the future, and position for them in advance. And I think part of that, as you alluded to, often it's quite useful to write about them because you end up you force yourself to go deeper into the ideas than you might otherwise do if you just don't take that time to sit down and actually write the thesis out. So I think writing the thesis down is quite important. And yeah, I mean, frankly, there's obviously been mixed success, but typically the reason that we exist in crypto is that this investing, in my opinion, is quite a bit easier here than other places. And so typically, I think we've had more success than not. The theses are generally correct. and they typically do play out when you come up with them in a thoughtful fashion. I think the harder part is not necessarily, well, one of the harder parts, not necessarily just identifying the thesis, but making sure that you execute on it properly and sort of maximize the opportunity. That can be more challenging than the actual thesis identification itself.
So take some time and talk about specific case studies. The first major thesis was the conversion of Ethereum as a blockchain from proof of work to proof of stake.
One of our large initial theses was around ETH converting to proof of stake, and we thought it was going to be very bullish for ETH, especially on a relative basis. And probably, just as a quick background from this one, a huge part of what we think drives price in this space, and frankly in every asset, but even more so in one that has more opaque fundamentals than others, is just flows, and a lot of structural flows that exist for not necessarily fundamental reasons. And so as a proof of work blockchain, you have to emit a lot more of the token to secure the chain than as a proof of stake blockchain. And importantly, that those emissions go to parties that are outside of the holder base. They go to miners who don't necessarily have to hold the token. And often, that's a commoditized business, and so they sell it. And so basically what you have is that in proof of work consensus mechanism, you have a lot of daily supply from these miners that sell the token emissions that they get for mining. But when you convert to proof of stake, that emission goes down dramatically, and even the percent of the emission that's sold goes down as well. So your daily sell pressure decreases meaningfully. And so the initial thesis on ETH was that would have a profound impact on the price of the asset, as you just erased all that future structural supply, especially versus the other large asset in the space, Bitcoin, which is going to continue as proof of work and have that ongoing supply. And so really it was an ETH BTC pair trade that was kind of the purest way to express it. And what we found is that going into the merge, ETH BTC did run up 50% into that event. Now, the interesting thing is that it topped before the event, and then after the event occurred, went straight down. It didn't go all the way back down to where it was before, but it retraced a lot of the move. And I think what this goes to tell you is that a few things. One, it goes back to that point about execution on the idea is often more important than the actual idea itself. But typically, when you have these large events, a lot of times they do get front ran, and often in crypto you find things are sell the news for this reason. And so trying to execute your entry and exit timing is very important. And I think what we learned from this one, being one of our first, is that each event is different. You can't treat them all the same. But often, if it's a very known thing that has been front ran and it's not followed by any immediate flows, then the events are often sell the news, and you need to exit whatever that thesis is before you actually get to the event.
So other theses that you've tried to exploit since launching Northrock?
So we did one quite recently that's interesting, which was on the Bitcoin ETF launch. We had a thesis that a lot of equity investors were crowding into the crypto equities themselves because they wanted exposure to crypto and Bitcoin, but they couldn't get it because there was no ETF. Yeah. And so our thesis was that this had pushed these to sort of unnatural valuations, whether it be Coinbase, MicroStrategy, Marathon. And we liked pairing those crypto equities short versus the actual underlying asset Bitcoin long, because we thought after the ETF launch, you'd see those flows migrate out of those equity instruments into the actual ETF. So we put on those pair trades, and they did work quite well. They roughly came down by 30 to 40%, and Bitcoin only corrected 10 or 15%. So I think that sort of pair trade was very thesis driven, and it was also very flow driven in terms of we knew when the flow would occur, and I think we did a bit better on that one in terms of timing it and executing it. And then we actually covered all those shorts shortly thereafter the ETF, and just kind of moved on from there.
So we take a few minutes, if you would, right now, to talk about the current state of play in the BTC ETF arena, and then after discussing that, give us a probability that you're attaching to the eventual SEC approval of ETH-driven ETFs and what that might mean for the ratio of the value between the two. Yeah. Just so the audience knows, the big picture here is as we speak today, late February 2024, the overall crypto market, add all the market cap up, and we can get into a question whether it's fully diluted value or not, FDV, but it's roughly 2 trillion, as you know very well, Hal. Half of that is Bitcoin. ETH today has very roughly a market cap of about 400 billion. And then the other 12,500 tokens in the aggregate are, the residual of roughly the 1.4 billion of the 2 trillion in total that I've just described. But come back to the question I put on the table. What's the current state of play with BTC as it relates to the recent launch of the ETFs? And then apply that conversation to what's going on in the ETH world.
Yeah, I mean, I think that the Bitcoin launch, no matter how you kind of slice it, has been wildly successful. The ETFs have taken in north of 5 billion of flows. Even after you strip out the GBTC outflow, I think that the net aggregate flow is still around that figure. They've been by the numbers, they've been the most successful ETF launch ever. So kind of no matter how you slice it, it does indicate that there is a very healthy, there was, I mean, it's unknowable at this point how much of that is sort of like one-time demand that couldn't access Bitcoin before versus more recurring demand that will continue to allocate. But regardless, I think it's pretty clear that there was some pent-up demand and there is decent institutional and retail interest to own these products. And so the Bitcoin launch has been wildly successful. We'll see what that means from here. A lot is priced in, et cetera. But it's hard to argue that the launch itself wasn't successful. And then in terms of ETH, it depends on the time frame that you're talking about. The relevant time frame right now is there's a deadline in May, and that's what everyone is keyed on as to whether or not the SEC will approve the ETFs in May. On that question, I personally actually am a bit pessimistic, and I don't think that we will get approval in May. Market's probably pricing it at 50-50, and I would lean towards no on that time frame. However, if you go further out 1 to 2 years, I think it is an inevitability, and it will come at some point. Now, what that means for the ratio of the two assets, I mean, it's quite straightforward. When ETH ETF gets approved, ETH BTC is going to rip. It's going to go up a lot. Because obviously you'll have people that could only buy one asset now able to buy both, and so they'll rotate some funds from one to the other. And ETH having better structural tokenomics than Bitcoin because of the move to proof of stake, a bit of structural demand there is going to go a long way. But it's very important to time that, because if we get the rejection in May, BTC is likely going to go down. So it's not a very good thesis, in my opinion, to just be long ETH BTC waiting for the approval at this point, because you very well could have to go through a rejection in May before eventual approval, potentially 1 to 2 years down the line, potentially after after the presidential election, if we get a different administration in office.
There are certainly people listening to us have this conversation, Hal, who actually don't understand or don't have prior familiarity with the distinction between proof of stake and proof of work. Maybe take a minute or two to give them a tutorial. What is the difference? And as part of that, I think you share my view. It's not an original thought, but ETH is distinctive, partly because of its backstory, but it is distinctive in having what some of our observers have called triple point asset status, meaning it's a capital asset, it's a commodity because it must be used as so-called gas to affect transactions on the Ethereum network. And it is potentially the third leg of the so-called triple crown, would be a potential store of value, as the other two properties, the capital asset property where you get a staking yield, and the utility as a commodity or gas, come to the fore. But that's a lot, but give them a tutorial. And as part of it, I'm interested in your own current opinion of the potential for ETH, the token, to become this triple point asset that people talk about.
Yeah. So just quickly on proof of work versus proof of stake, what we're talking about are, they're called consensus mechanisms, and it's the means by which a blockchain is secured and transactions on the blockchain are validated. You need a party to do that work, and you can do it in several ways. The original way that Bitcoin did it, and all of this came from the advent of Bitcoin itself by the Satoshi Nakamoto Bitcoin white paper over a decade ago, which sort of gave rise to proof of work. And what that said was that you had these outside parties called miners who would compute a hash and do this work in order to then validate transactions on the blockchain. The whole point that you need some proof of something is to avoid spamming the network. Because if you don't have proof of something, then anyone can just spin up a lot of nodes and just claim and just do whatever you ask them to do from many different places and pollute the network. And so you need some hindrance, some mechanism to force to prevent that. And so what the advent of proof of work said is that you have to actually perform work and then prove that you've done it in order to be given the right to validate the transactions on the blockchain, secure the blockchain, and get the emissions and reward for doing so. And so the mechanism that came up for Bitcoin was called proof of work, where you have to compute a cryptographic hash, which is very compute intensive and requires a lot of resources. And then if you prove that you've done that, then you may get selected to validate transactions and secure the blockchain and then receive blockchain rewards, in this case, via actual Bitcoin. That's proof of work. And so the Bitcoin themselves goes to these third-party miners who do this work and validate the blockchain, and in exchange they get Bitcoin. Now, proof of work says rather than actually proving that you're doing some work, which is quite compute intensive and therefore eats up a lot of resources, rather just prove that you own the token. And that's why, as the name would suggest, proof of stake implies proof that you actually own a stake in the network. And so you can just take your tokens and contribute them to the network and prove that you own them. And then in exchange for doing so, then you could be chosen to validate the transactions and get your blockchain rewards. And because it's much less compute intensive, the amount of emissions that it requires to sustain is much lower. And it's a much more efficient mechanism of actually just validating blockchain. So that's the distinction between proof of work and proof of stake. And today, vast majority of blockchains just use proof of stake, and they've kind of settled on that as the optimal mechanism. Bitcoin being the primary one that does not. And then in terms of ETH as a triple point asset, I think it's already happened. I would define the 3 points a little bit differently than you did. I would say one is, yes, a store of value. That's, a la digital gold. That's what Bitcoin is really the leader in at the moment. But I think ETH also competes for is just some decentralized asset that if some destabilizing force or some issue hits the world, that does not depend on any one government and can be relied upon to store value in if society sort of breaks down. I think that's generally what people use gold for, and Bitcoin, and I think ETH's also competing for that, just in the nature that it is decentralized. If something were to happen to any one government around the world, ETH would still exist and it would still retain value. Same with Bitcoin. So that is one of the 3 prongs. The second prong that I would say, you define it as a capital asset. I would just call it an equity. Basically, you have your share to the profits generated by the network. And as ETH, you have that because when you stake ETH, you actually get the fees paid to use Ethereum on the network. So that is the profit you generate. When you want to do a transaction on ETH, you pay ETH. That ETH gets distributed to all the people who stake their ETH. So as a holder, you can stake your ETH, and then you have claim to all the revenue generated by Ethereum, which is actually a substantial amount. And so I think it also fills that second bucket as what I define as an equity. And then the third bucket, I wouldn't necessarily call as a commodity. I would say it's more of a currency. And it has its own natural sort of ecosystem and economy that exists in the network that you need ETH to participate in. And so whether that be actually paying for transactions, that can be one form of use of ETH, but also whether you want to buy an NFT or trade for some other token, it's all denominated in ETH, and ETH is the native currency of the ETH ecosystem. And so I think you need ETH for all 3 of those reasons, either to store value in, to claim a portion of the profits generated on Ethereum, or to participate in the Ethereum economy.
And if you would, Hal, take a minute to explain why some observers, and perhaps it includes you, when they think about the very, very long-term security of these 2 leading networks, Bitcoin on the one hand and the Ethereum network on the other, many would argue that Ethereum's very long-term security properties are much greater than Bitcoin's. And I want you to explain why they're taking that view, and in the process of doing so, articulate your own view of the very long-term capacity of Bitcoin to defend itself.
Yeah, I mean, it's a very interesting question, and you could spend the whole episode talking about this one. But if I try to summarize it, the issue, well, I've written at length about this, and maybe you can link it when you post the episode because it'll go into a bit more depth. But at a high level, proof of stake inherently, I think, is more secure long term than proof of work because it's nearly impossible. Well, if you have a high staking participation rate, so it's nearly impossible for an attacker to accumulate enough of the stake to occupy 51% and attack the network, which is ultimately what you need. Because the main reason for this is that every token you buy, the next one after that becomes harder to buy by nature of the fact that you just bought one before it.
Sure.
The supply is limited. Whereas with proof of work, you just need to assemble enough hash, which you can do through accumulating these mining rigs, and then bring it on all at once to have 51% of the global hash. And there's not necessarily a limiting factor to doing so. So that's kind of like one distinction. But then another distinction is just that the actual security of the network comes from the revenue that it generates that it can then use to pay people to secure the network. And Ethereum, just being a much more programmable network, has a lot more revenue generating potential than Bitcoin does because there's a lot more activity that occurs on Ethereum. And so that also helps increase its ability to defend against attack. And then lastly, on proof of stake versus proof of work, proof of stake is roughly 20 times more efficient than proof of work in actually generating the security in addition to the other 2 points. So if you generate $1 of revenue and you pay that out to your stakers, on Ethereum, that generates 20 times more security than it does on Bitcoin. Roughly, and the math to that maybe you can link in the article that I mentioned. But that's at a high level the distinction that I draw.
Yeah.
So and then for Bitcoin, there's another added issue here, which is that because they have chosen to cap the supply via these halvings, where the emissions get halved every 4 years, you reach an end state point at some point in the future where your emissions become quite low and your security potentially becomes quite low with it, unless you generate enough fees on the network outside of emissions to compensate for that. And it remains to be seen. Bitcoin is making some progress on this front. They have started to generate a lot more revenue than they have in the past via a few new things that have taken off. But it definitely remains to be seen whether or not they'll be able to generate enough to actually secure the chain long term.
Yeah, and just to offer 30 seconds of explanation, what you've just alluded to, I believe indirectly, are the so-called layer twos, the roll-ups. These are terms of art in the crypto sphere that people look to Bitcoin and say, well, the original settlement layer, the peer-to-peer transfer of value that was in the original white paper when it was published in late 2008. Yeah, we can build on that in a manner that mitigates, maybe in the very long term, eliminates the security concerns that you've talked about by generating enough sort of exogenous revenue to make it worth people's while to provide the security. That's in essence what you were getting at. Is that correct?
Yeah. I mean, and it's not necessarily just through rollups. You can also have activity on the layer one itself. But yes, rollups are one mechanism one means by which you could try to go about generating this activity.
Great. So what we just talked about, in my own view, biased though it is, it sets up nicely. I'm going to ask you in the audience to bear with me. I'm going to read a pretty long quote from a podcast that featured somebody you and I have actually spent quite a bit of time listening to, Justin Drake, who works for the Ethereum Foundation itself. He's very articulate. He's very smart. He's a very, very thorough researcher. And I found the quote that I'm going to read when I first listened to it a few weeks ago really arresting. And I thought I should ask Hal about that on the air. So bear with me. I'm going to read it to you. And as soon as I finish reading it, I'll just ask you to take however much time you want, Hal, to talk about it, because there's a lot in it. Okay, with that as preface, here's the quote from Justin. With clever engineering, a lot of the bottlenecks we're suffering today, things like state bloat or verification of execution, all of these things go away. And you're left with one fundamental bottleneck: bandwidth. When you combine dank sharding, and I'll ask the studio if you could post, I'm going to read, you don't need to show Hal and me, Eric or Ethan in the studio, post the quote that I'm now reading, if you would. I think it's the first slide in the deck that I gave you for today. Thank you. I'm doing that because there's a definition of both dank sharding and Nielsen's law, which I'm about to mention on the slide, which viewers can review at their convenience. So going back to the quote, when you combine dank sharding, which is basically a way of getting more capacity in the network, with Nielsen's law, which is a law, as an aside, that says basically bandwidth expands at about 50% every year. It's a variant of Metcalfe's law. Of Moore's law about semiconductors. When you combine dank sharding with Nielsen's law, compounded over 10 years, we'll be in a position where we can do 10 million transactions per second on the Ethereum network. Continuing with the quote from Justin. That's enough for every single person on Earth to do 100 transactions per day. In my opinion, meaning in Justin's, that's enough. We'll be in a position where the entire internet of value can be in one place with shared security. Under the hood, there are modules, but these are integrated modules, and we only buy into one security assumption, which is that Ethereum is secure. This brings us to trying to grow the economic security of Ethereum. Right now, we're at 70 billion, roughly, and that's 29 million ETH outstanding times ETH's price when Justin recorded the podcast I'm alluding to. Continuing with his quote, I'm hopeful we'll get to $1 trillion of economic security, or even trillions of dollars, at which point we'll have unquestionable security, even against nation states. And we'll be in a position where the internet of value is unquestionably secure, and Ethereum is unquestionably the place where everything happens. Discuss.
So I guess what I would say is Ethereum is a project that has a lot of promise, obviously, and I've written about at length, and is still in the development of the end state. Like, it is not today fully developed and complete. The core developers work on new upgrades all the time. There's one scheduled to happen next month, actually. And then there's another one that happens roughly every 6 to 12 months thereafter, as they continue trying to iterate to get to the end state that Justin's alluding to. Dank sharding is going to be in one of those upgrades as well. So I'd say that's one impediment to getting there. But then, it is not as if there are also no competitors. There are other projects trying to compete for a similar thing, and it's also not certain that it's going to necessarily settle all on one blockchain. Hence, different people have different views on this. But what I would say is, of all the chains that exist today, in my opinion, Ethereum has the best chance of getting there. You never know, obviously, but if I had to rank them, I would put Ethereum first in terms of accomplishing that goal, if any of them are to ever actually accomplish that goal. To accomplish that goal, in my opinion, does require, this is where it gets a bit more tricky. Well, it depends how broad-based you want the goal, but to really implement sort of everyday utility, in my opinion, it does require government integration, which is a bit of a difficulty and a whole unexplored area. That's another challenge, I think, to really sort of like meeting that broad-based vision.
Yeah, let's just pick right up on that. Talk about that. We haven't talked about stable coins to this point in the conversation. We haven't talked about USDC, one of the leading stable coins. Tether actually has a bigger usage at present. You'll recall, I recall it very fondly, that Anders Brownworth and I jumped in the car and came down and spent the better part of a day with you. Not all that long ago, when Anders was running the project within the Fed to design a so-called stablecoin, a Fed coin. He's since left the Fed for various reasons that give me pause about the rate at which they might introduce it. But I actually, Hal, I'll put the opinion out there and let you either agree, disagree, and explain why. But I think it's inevitable, actually, if we roll out the clock far enough, that we're going to have a US dollar backed or based stable coin used very widely through the global economy, whether it's purely government backed or it's USDC or something like it, maybe even Tether, that gets sort of semi-nationalized. I don't know. I don't have a clear picture of that. But I actually think if we depart for a minute from crypto investing and open up the lens with a much broader macro purview, I actually think what I've just talked about, and I want you to push back on this if you feel comfortable in doing so, could actually mitigate concerns that people rightly have about the long-term material debasement of the US dollar's purchasing power. Because I actually think the introduction and expansion of US dollar-based stablecoins could very materially stimulate demand for the currency that some observers are saying is destined to become materially debased. So that was a lot, but take it in whatever direction you want.
Yeah. I would just say on the stablecoin front, it remains to be seen, and it will depend a lot on sort of ongoing legislation. But I don't disagree with you. Certainly, it is a way of establishing the dollar. I mean, frankly, the dollar has already been established in crypto. Everywhere around the world, everyone pretty much uses these USD denominated stablecoins for everything.
Yeah.
And so that's sort of already happened to some degree, which ultimately does create demand for dollars. Now, separately, kind of the point that I was making was actually less about stablecoins and more just about broad-based government integration. So, like, for example, if you're going to have the blockchain integrated more closely with day-to-day life, you could do things like having homes represented by tokens on the blockchain. And then when you went to actually do a home buying process, it could be simplified and made more efficient through this means, where you could actually just transfer the value of the home through a transaction on the blockchain from one owner to another. And then I think a lot of the value of blockchain doesn't necessarily just come from the initial application, but rather a lot of the follow-ons that are made much more frictionless by nature of them happening on a blockchain. So it's not necessarily the home sale process, but then if you want to take out a mortgage, it's quite easy to then just give your home token to a mortgage company that can then send you money back, and then you can have some smart contract to determine how to manage, or if you want insurance on the home, et cetera. These sort of tangential applications become more simple on a blockchain, and I think that's kind of like, you want to really dream big. Those are sort of the applications where you could actually create a lot more day-to-day utility for everyday and just more broad-based part of the population. But those things really require government integration. I can't have a token on the blockchain represent ownership of a home unless I have some way of enforcing it. Right now, if I own a home and someone comes and tries to live in my home, I can call the police and say, this person is trying to live in my home, please come take them out. And they will, because I have like proof of ownership of the home through the legacy system. But if I just own a token that says I own the home, the government doesn't recognize that as ownership. And so therefore there's nothing I can do to kind of like defend my home, which I need the government for. So you need government integration to recognize these assets as what you deem them to be in order to have this sort of utility. And so that's the sort of government integration that I'm referring to, that I think is going to be really, really complicated to produce, but is necessary for a lot of these applications.
So not putting you on the spot, but I'm keenly interested in having you attach a probability. What probability do you attach? I'll say over the, you're fortunate enough, you're a lot younger than I am, which is among many reasons why I respect so much what you've already been able to accomplish at a very young age. But look over the span of your lifetime. What probability do you attach to those methods of transferring value and securing ownership actually becoming used on a widespread manner in the course of your lifetime? And if indeed we attach, second part of the question, 100% probability, just for discussion purposes, to them becoming realistic, practical, and cost-effective, are we talking about 10 years from now, 50 years from now, maybe even fewer than 10 years from now?
Yeah, I'm a bit more pessimistic, probably. I don't, it's hard to ballpark exact probabilities, but I would say sub 50% that we see that sort of broad-based integration within my lifetime. I just think there's a lot of impediments to it, and it's very complex. I don't think it's, I would say it's north of 10%, but certainly sub 50 in my opinion. If it were to happen though, I think there's probably a window where it would happen in, like, the next 20 years, where it would be more likely than after.
Let's go back to investing a little bit and spend a few minutes talking about principles that folks that are listening to us may be able to apply to arenas other than crypto investing. One of the aspects of your sort of march through your professional life and your original articulation of your approach to me that I found so attractive is when you talked about your so-called 90-10 rule. Just explain to the audience what you meant by that, and how you came to adopt that rule and how you've actually put it into practice.
Sure. Yeah. So what I define as the 90-10 rule is, I think there's a lot of investing is about kind of taking the right bets and not taking the wrong bets. And I think in any space, there's a lot of medium conviction things that come along. A lot of sort of mediocre opportunities, and you can waste a lot of time trying to pursue them. And then they'll detract from the truly high value opportunities. So I would say that 90% of opportunities fit in this bucket of being sort of just mediocre. And then there's 10% that are truly high value, and you should focus all your attention on the 10%. Another way to say it is just wait for a fat pitch to swing at. Like, don't swing at just any pitch. Just wait for a really good one. And this is something that I've certainly tried to employ throughout my investing career, and I think is still part of my philosophy today. And I think it's definitely been beneficial to our success.
So how long did it take you in hours, measured maybe in hours, or days, weeks, months, years, sitting on the Morgan Stanley trading desk for you to recognize the benefits of adopting that rule?
It took me a year, I'd say. I learned a lot in that first year, and that was really where I figured that one out.
Yeah. Let's just stick with that experience for a minute. I teed this up in advance with you, but I really am keenly interested. I think others listening to us might be as well. I hope they will be. What sort of strategies and tactics that you employed successfully in that role, sitting on the Morgan Stanley options desk, did you discover when you went to apply them to digital assets simply didn't work and don't work?
Yeah. I mean, I think ultimately what it comes down to is the fact that crypto is just much less efficient than equities. And in equities, you can rely on a certain level of efficiency to dictate the markets, because you just kind of have enough actors that will enforce them that they typically exist that way. I mean, it's not always that way. We saw with the Wall Street bets craze that certain times you can get wild inefficiencies that really break these rules. But for the most part, the market is generally quite efficient. I mean, there's obviously inefficiencies. No market is perfectly efficient. I don't believe in the perfect an efficient market hypothesis, but it's a degree of which it's efficient. I think that like the general equity from the U.S. equity market is quite efficient, and then crypto I think is a lot less efficient, and you can have a lot more sort of like irrational things that happen for more technical reasons over short periods of time. And so I think you can relying on a certain level of efficiency can work in equities, but it breaks down in crypto, and you have to spend a lot more time focusing on technical factors and flow-driven factors as to why assets move as they do.
I take it you would agree with the assertion that price drives narrative and not the other way around. And I'm wondering, since you've been both in TradFi and traditional markets and in crypto, the extent to which you think that principle, if indeed you buy into it, price drives narrative, not the other way around, applies with greater force in crypto, digital assets, or in TradFi.
Yeah, I think with like anything, it's not binary, but I think typically that happens a lot more than people think, where some technical force will drive price, and then that will create a narrative to form around it to meet that price action, versus actually the fundamentals driving the price themselves and then the price, you're sort of driving the demand itself, and then the price following those fundamentals. I think to your point, it does probably happen more so even that way in the crypto space because the fundamentals are really opaque. These tokens don't generally trade on PE multiples or within valuation frameworks. They trade in a much more broad and sort of opaque fashion. And so it's much easier to just craft any narrative you like to support price action. And so often what you'll find is that the price action is dictated a lot more by the flows, and then the narrative crafts around it to match what's happening with the price.
And would you, going back to Ethereum and to ETH, particularly the token, would you say that ETH itself is actually amenable and susceptible to kind of rational discounting cash flow analysis? In other words, yeah, go ahead.
You go ahead and finish.
I was just going to say that it constitutes an exception to the general rule that the sort of ethereal, ephemeral character of most of the 12,000 available tokens is such that you actually can't apply a rigorous, not rigid, but a rigorous discounted cash flow analysis to it, whereas maybe you can with ETH.
I shy away from doing so with ETH even. I think ETH, there's actually tokens that I think are even better at it than ETH, some application layer tokens. The issue with applying, so I'd say two things. So first of all, ETH does generate cash flows, and you could try to discount them back and come up with the present value. The problem is that the value of the cash flows themselves are very correlated to the price of Ethereum. So the reason that discounted cash flows work in traditional equity markets is because the value of the cash flows is not correlated very closely to the price of the stock. They come from some real world business. If you have a lemonade stand that sells lemonade and it generates $1 a day, whether the price of that lemonade stand goes up or down is probably not going to change the $1 a day that they get from selling the lemonade. However, and that enforces some range where if the price differs materially from what people think it's worth, it has a mean reverting force where over time the company will either make enough money to push the price up because they'll generate the cash flows, or other rational actors will sell the price because they're not getting the cash flows that they want and push it back down. And so this creates like a mean reverting effect where the fundamentals actually do sort of contain the price in some band. But the problem if you try to ascribe this to ETH is you say like, okay, ETH went down 50%, it must be a good buy. But the problem is because ETH went down 50%, the revenue probably actually fell even more than 50%. So it doesn't really work because the actual revenue of the protocol is extremely closely linked to the price of the asset.
Yeah, so putting maybe the same point a bit differently and tying it into TradFi personalities that most of our audience will be familiar with, like Soros famously, is associated with the idea of reflexivity in financial markets. And I guess your view would be how you'd say to George, hey, you ain't seen nothing in TradFi. No. If you want to see reflexivity, come over to my world, right?
Crypto is definitely extremely reflexive, reflexive.
Right,
there's a lot of things that enforce that reflexivity.
Sticking with TradFi for another minute or two at a minimum, we've got about 10 left to go here. I'll ask our good friends in the studio to flash the other slide that I furnished, which is a rather cluttered table. Many of them actually watching this podcast will have seen a variant of this before. It's sort of my single favorite mapping and measuring of what goes on in financial markets. It's done through the prism of the US stock market. I shared it with you offline prior to starting the Zoom, Hal. I call it, for lack of a better term, long-term winners in the US stock market. And I've updated this study sort of at least biannually for more than 20 years. And it's intriguing to me. I usually do it for 30 years, 25, 20, 15, 10, and 5. And it's hugely interesting to see what stocks bubble up to the top of the list. I mean, when I started doing it way back when, you had more than like 6,000 publicly traded US stocks. Now we're down to a much smaller number, but many of these names that people, if they want to study the table, will be amply familiar with some of the names, and obviously not at the 30-year level because it hasn't been public that long, but NVIDIA, much in the news of late, has started to make its way up towards the top of some of the shorter term timeframes, 10, 15, and 20 years. The reason, as you know, Hal, that I'm putting it on the screen is because I want to put the following question to you. if we come back, if we go out 30 years to the year 2054, or maybe 25 years to the year 2049, or even 20 years to the year 2044, and we have a crystal ball to look at this exhibit as of those 3 dates, what probability would you attach to Coinbase, ticker symbol COIN, being on any of these lists of top 10 over those specific time periods, the next 30 years, the next 25, and the next 20, and why?
I'd probably ascribe quite a low probability to it. I don't know how to quantify it, but I'd lean towards being more pessimistic, not because of a view on crypto, but just because of a view on Coinbase's business. I don't think it's that great of a business. I think it's competitive, and I think they're going to see a lot of fee compression. I don't think there's an enormous barrier to entry there either. And also quite a high starting point. I think like if you're going to look at those lists, you're typically going to find things that start at very low valuations. And so if we're talking about it from today, Coinbase is already worth a lot of money. So those two factors, I'd probably ascribe a lower probability to it. Versus I think if you want kind of like truly exceptional returns, there's a lot of probably individual tokens that you could find that exist today that are probably quite a low cap that will have sort of that kind of like exponential return that will be embodied by that list. So I do think there will be certain crypto assets that probably perform in line with those stocks that make it to the top, but I don't think Coinbase equity is likely to be one of them.
So having promised you in advance that I would only ask you about one stock coin, and I wouldn't ask you to talk about any specific tokens other than maybe ETH and Bitcoin, I'll now break that promise and say, are there any specific coins that you had in mind, tokens, when you just said some of them have that very long-term explosive potential? You don't have to answer that question. And if you do, you should disclose whether they're in your book at present or not.
No, there's nothing that I would bring up. There's nothing that I would mention off the top of my head at this point, no.
I'll give you another one because you alluded earlier to the potentially explosive upside potential of what you call the app layer tokens. So the one that comes to my mind is DYDX.
Mm-hmm.
Why don't you just explain to the audience, many may not be familiar with it, what is it, what's the business model, why might a fair-minded observer say, maybe not the only one, but that particular app layer token and others perhaps like it, have a lot of potential?
Yeah, so I mean, I think app layer tokens are quite interesting for more like traditional equity investors because they do have businesses that are less correlated with their own token price. So the layer one token price, often the revenue of it is very correlated with its token because its token is the currency that people have to pay to actually operate. So by nature, if its price goes up and down, so does its revenue because its token is the actual currency. Yeah. But something like DYDX, app layer tokens, their token is not the currency that people use to pay. People are paying. DYDX is a decentralized perp exchange, and perp stands for perpetual futures contract, where people can go and trade cryptocurrency futures on this decentralized exchange, and they typically pay fees that are determined as a percentage of the notional that they trade, and not have any link to the price of DYDX itself. And so that creates a more uncorrelated revenue stream for DYDX, where it can then be valued more as a traditional business. Yeah. And that's obviously interesting to like more equity-minded people that want to have this sort of fundamental value. Now, DYDX itself, I think can do well, but I don't necessarily think will be one of those explosive sort of return profiles for a couple of reasons. One, it suffers from the same problem that Coinbase does, which is already a high starting value. So it can make it go up, but the odds of it going up 100x are quite low. And then number two, that actual vertical itself is also quite competitive. There's a lot of different protocols competing for that same market. And so it's going to be hard for the large incumbent to produce sort of explosive returns on a forward-looking basis.
I have two standard closing questions, as you know, that I pose in all the interviews that I conduct. I'm going to come to them in a minute, but I'm going to just slot in another question before I pose those closing two questions to you. And it concerns, a very visible personality in the digital asset arena. I have my own opinion of him, but I'm curious to have you comment on Michael Saylor and what he's done with MicroStrategy.
I think Michael Saylor is a genius. Actually, I think he's done extremely well he's done extremely well for his investors, and he's done extremely well for himself. Now, I think that the price of MicroStrategy stock is overpriced, certainly relative to the underlying holdings. So I wouldn't own MicroStrategy, but I think that Saylor himself is clearly extremely intelligent, was extremely early to understanding the merits of Bitcoin, and has showed really sort of like exceptional steadfastness to hold that view so consistently. So I'm quite impressed with Saylor, regardless of the fact that I think MicroStrategy is overpriced.
At the risk of having you truncate your answers, one or both, to my closing questions, I'm going to ask you to take maybe 30 seconds to give us your assessment of Vitalik Buterin, the founder of Ethereum Network.
Another extremely impressive person. I think of our generation, he's one of the more influential sort of innovators that we've seen, and kind of given rise to a lot of what exists today in the blockchain space. But also, I think he's just clearly a very good and properly incentivized people. Like, I think he genuinely cares about trying to do things the right way and operating for the force of good, and then having sort of merit-based approach and really and being quite moral about it. So he's another truly like sort of exceptional person for different reasons than Saylor, but also someone I'm very impressed with.
Yeah, I am too with Vitalik, far less so with Saylor. I'll just leave it at that. Okay, two closing questions. The first one is, Hal, what is the greatest display of grace under pressure that you've ever witnessed in real time, in person or on TV, but replays don't count?
This one has very little to do with blockchain, actually, and nothing to do with crypto. But my biggest hobby outside of investing is spear fishing. And I have a mentor, a guy named Tim McDonald, who actually has a YouTube channel nowadays. I did a semester abroad in Australia when I was at Duke. And I met Tim there and went spearfishing with him a lot. And spearfishing it's all breath hold. So it's hold your breath, swim underwater, shoot fish.
Yeah.
And he was a mentor to me. His grace, sort of spearfishing with many large sharks in Australia is definitely the first thing that comes to mind. And he's a very devoutly religious person. And I think that probably gives him some of this grace, but he's just the most cool cucumber under obscene pressure that I've ever seen.
I didn't know he had a YouTube channel. I'll go and watch that.
Yeah, you can.
Okay, final question, and we got to wrap up right soon. If you could accomplish just one feat, F-E-A-T, during the remainder of your lifetime, subject to the condition that no one would ever know that you'd accomplish it, what would that feat be and why?
It's hard to identify sort of like one specific accomplishment, but I think generally the goal for me is just to leave no stone unturned and just not take any shortcuts. And kind of just, as long as you do that, as long as you do the best you can and know that you weren't lazy, you didn't just decide, you didn't just take the easy path or cut corners here or there, you sort of just have to live with the results and let the chips fall where they may. So as long as I can, at the end of my life, look back and say that I did that, I'll be satisfied.
Good note to wrap up on. Hal, thank you very much. I always enjoy our conversations. Look forward to the next installment, and I hope our audience will look forward to episode number 2. We have a terrific guest, not yet disclosed, lined up for it, and we're really excited about it. So thank you all for joining us, and hope the rest of your day go really well. Thank you, Hal.
Thank you, David.